you pick the right stock at the right time.
Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines this morning. Asian stocks are off to a weak start after warnings from IMF and World Bank leaders over increasing volatility and trade tensions. Hindustan Unilever's second quarter results met analyst estimates. The FMCG major reported a volume growth of 10%. IndusInd Bank's stable earnings performance is likely to continue during this quarter as well. Commentary on exposure to Island FS and the merger with Bharat Financial will be awaited. Former Finance Minister P. Chidambaram slams the government's management of the economy, says the macroeconomy is currently in very poor shape. And Minister of State for External Affairs M.J. Akbar says the allegations against him are baseless and that he intends to take legal recourse. Let's talk about what happened in the U.S. markets on Friday. U.S. stocks closed higher on Friday, clawing back some ground that they lost in a two-day rout that saw the Dow lose as much as 1,300 points. But they still suffered their biggest weekly loss in 6 months. Bloomberg's Abigail Doolittle wraps up all the action on Wall Street in this report.
Stocks finished sharply higher in Friday's Wall Street session. It was a real rebound rally from the selling that the major averages suffered from earlier in the week. The Dow did rise by about 1.2%. The S&P 500 was up 1.4%. The tech-heavy NASDAQ outperforming up 2.3%. That was the best day for the S&P 500 since April, and for the NASDAQ since March, on lots of volatility, though. At one point, the Dow did flip briefly negative, and the S&P 500 and the NASDAQ had paired their gains, but the bulls, the buyers, did step up at the end of the day. Relative to sector composition, mainly green. 10 of the 11 S&P 500 sectors finished up, led by technology, up 3.2%. The only down sector, real estate, among the best boost for the S&P 500, Apple, Amazon, Microsoft, Visa, Alphabet, and Netflix. Netflix, of course, does report earnings next week. Investors will be waiting to see what that report brings, and one analyst upgrading those shares to a buy, an opportunist upgrade ahead of that report. Now, bonds and the yen fell on the day. That does point to a risk-on day, but on the week, it's a different story. Each of the major averages down sharply, the worst week since March, and on the week, both bonds and the haven yen higher, telling us the week was truly risk-off. Uncertainties around rising rates, trade, the possibility that stocks really just ran too far too fast. Critical earnings reports could really sway the markets next week, including Bank of America, Morgan Stanley, Goldman Sachs, and, as I had mentioned, Netflix. It'll be interesting to see what next week brings after a third down week for the S&P 500 and a truly risk-off week despite Friday's relief rally. In New York, Abigail Doolittle, Bloomberg News.
Well, it's earnings season back home, and before we get into the trade setup for the day, Darshan will be here very shortly. I just want to tell you about the Asian markets that have opened so far. The three early risers, when I checked earlier this morning, had sharp cuts. The Nikkei, in fact, was trading with cuts of as much as 1.8% at one point of time. It has recovered some ground, and it's currently trading about 1.5% lower. You also had the Australian benchmark, which was trading with sharp cuts. The Kospi continues also to trade with cuts of about 0.5%. The Chinese markets have just about opened up, and you can't really see anything decisive in the way that they're trading in the first few minutes. But the Hang Seng is opened with cuts of over 1%. So it looks like it's broadly going to be a weekday of trade in Asia this morning. But, well, like I said, Darshan Mehta is here to tell you all about the trade setup for the day and also to tell you what's happening in the futures and options space. Darshan, if I understand correctly, the SGX Nifty was indicating a positive outlook. It so far lost a little ground. How's it looking this morning?
Yeah, so when we were doing the podcast, it was up 40 points. That was around half an hour ago. It slipped into the red because there are more cuts in Asia. US as a region had done extremely well, and that's why the positive traction on the SGX. But with Asia failing, there seems to be problems that are there for the SGX Nifty. So if you pull up the SGX Nifty, was up 40 points, now down almost 12 points at this point of time. So below the 10,500 mark in trade. The ADRs ended up well. All the ADRs ended with positive bars. You could see the gains that came in counters like Vedanta, HDFC Bank, Tata Motors. In Infosys, all of them up over 2% in trade. So great days as far as the ADR was concerned. Even here, if you're looking at our markets, strong traction. The Nifty was up 237 points, close to the 10,500 mark in trade. And across the board, there was buying seen. The mid cap, the small cap, you could see gains in excess of 2.5% that came in. Even the Nifty, the Bank Nifty, the Nifty PSU Bank, all of them seeing strong traction in trade. Some of the sectors that managed to move up significantly were the high beta counters, the metal, the auto, and the real estate pack. All of them gaining in excess of 3.5% in trade. So it was a strong Friday session where we had none of the stocks, none of the indices that managed to lose out big time. FIs were net sellers to the tune of 1,300 crores. DIs were net buyers to the tune of almost 1,200 crores in the market. Now, if you're looking at what contributed to the Nifty's 237-point move, Reliance contributed, HDFC Bank contributed, ITC contributed, and HDFC contributed. So basically, the top four companies with substantial weightage on the Nifty contributed. The biggest company in India, TCS, post an inline set of numbers and the markets didn't like that. That was down in trade. IT and pharma was slightly weak given the fact that TCS disappointed and the rupee has now started to appreciate against the dollar. As far as the F&O market is concerned, if you're looking at the open interest build up on the Nifty, it was down 2%, indicating that there was short covering that was seen on the market. On the Nifty Bank, what we are seeing is the fact that there was fresh buying. Open interest was up 4%. The index was up 2.5% in trade. What happened on Friday? Because of the sharp move, what we're seeing is that resistance is at 10,000 and the support is at 10,000. The resistance is at 11,000 right now. We are close to 10,500 in trade. Put writers, call writers are active from 10,500 to higher levels. If the market takes 10,500 by force and manages to sustain, there will be unwinding pressure that will come in. But the position on the lower side for the call writers is light. What put writers are doing is the fact that they are writing in from lower levels right up to levels of as high as 10,700, 800. So they're trying to give in a bullish trade. What happened on Friday? Call writers had to shed positions in open interest. Put writers wrote positions in open interest. But remember, even after 10,500, they're not writing. So that means the upside, even by the bulls, seem to be limited at this point of time. As far as the stocks in the F&O band is concerned, IDBI continues to be in the F&O band. The new addition that comes into the F&O band is Adani. So that's something that you need to watch out for. Open interest build up, Nifty futures, Nifty PCR moved up to 1.21. Nifty Bank PCR also managed to move above the 1 level mark in trade. A couple of stocks that I want to highlight. TCS of fresh shorts, open interest build up of 8%. The entire IT pack is looking weak, and if the rupee continues to appreciate, there will be potential more weakness on the IT sector. Mindtree is another counter with saw fresh shorts, open interest build up of 3% on the short side. The third counter I want to speak about is NIT Tech. Again, look at the open interest build up of 30% open interest build up on short side. So that's IT for you that's looking weak, and SRF was the other one which managed to gain on open interest build up of 10%.
Thanks so much for that, Darshan. Well, let's talk about the commodity space now, and Jayesh Khilnani is joining in with all the updates there. Good morning, Jayesh. Significant updates in the crude space?
That's right. In fact, Alex, if you look at the morning screen, crude has been showing some bit of positive bias. But if you look at last week, it was not that great because oil posted its biggest weekly loss since May last year. And this is despite the fact that IEA has now cut its demand growth forecast, but still sees the prices on the higher side. In fact, ABN AMRO has come out with a note in which they have predicted 2019 Brent forecast to be nearly $5 higher to about $90 a barrel. Now, as far as base metals are concerned, we saw some bit of green over there as well. Now, this was largely provided on account of the Chinese import data that we have. So we had individual base metals like copper, which posted its first weekly gain since in the last 3 weeks. Now, aluminium also snapped its 6-day losing streak, and we had lead and zinc, which advanced on LME, while tin and nickel fell on the London Metal Exchange. As far as gold prices are concerned, we saw gold, giving up some of the gains that it had piled on last week on account of the equities and dollar rebound during Friday's session.
All right. Thanks so much for that, Jayesh. I do want to point out the rupee. In fact, if we can pull up the USD INR and look at the chart for the last 3 days, you'll witness that there has been a bit of a bounce back for the rupee. It's appreciated, in fact, according to what I can see on my screen, by as much as 80 paise. That amounts to about 1.1 percent. So in fact, what Jayesh was mentioning about the rupee, in fact, is a significant, or rather not Jayesh, sorry, I was reading on the website about the rupee, and Darshan was talking about the impact on certain stocks that could happen because of the appreciation of the rupee that you've seen, and you can see, in fact, on your screen. But meanwhile, I think one of the big talking points today will be earnings, and IndusInd Bank may continue to post a good run and post a 23% rise in net profits. Shraddha Babla is joining us with all that you have to watch out for. Good morning, Shraddha. What are the headline numbers to start with?
Right. So overall, Alex, it's largely expected to continue to remain those kind of steady earnings trajectory that we have been seeing from IndusInd Bank for the past multiple quarters. So in terms of the key numbers, net interest income is seen growing by about 21%. Net profit is seen 23% higher at 1083 crores. And overall, net interest margins are expected to remain steady on a sequential basis at closer to 3.9 to 4%. In terms of the other parameters, some sort of a healthy growth in fee income could be offset to some extent by lower treasury gains, which should lead to an overall muted performance as far as the other income is concerned. Loan growth is expected to sustain around that 25 to 30% levels, even as retail loan growth continues to remain strong across retail products. And in addition, in case of IndusInd Bank, corporate trend, a growth trend will also continue to remain strong. Asset quality trends are likely to remain steady. Slippages in the first quarter were about 475 crores, so they should trend closer to that number, and credit costs also expected to remain within the guided range. So then what would be the most important thing to watch out for is going to be the treatment of the IL&FS exposure and provisioning for the same, which will be the key monitorable. Continued traction in the commercial vehicle segment and market share gains overall for vehicle finance will be important to monitor. And finally, also the details with respect to the merger of Bharat Financials and expected synergies from those transactions will be what will be most important to watch out for.
All right. Also, Shraddha, there's Indiabulls Housing Finance to watch for. It's expected to post a 23% jump in profits from what the estimates are. Could you also give us an idea as to what to look for in those earnings?
Right. So, Alex, once again, earnings consistency is expected to continue, especially within the guided range, aside of the funding issues and liquidity crisis, which had led to, the stock slumping since the end of September. But overall, as far as Q2 numbers are concerned, they're expected to continue with the past growth trajectory. So the net profit is seen about 22% higher at 1053 crores. AUM growth is expected to remain strong and steady, seen at closer to 30% levels. Asset quality is also expected to be broadly stable on a sequential basis. Spreads, on the other hand, are expected to moderate given some sort of a compression in the mortgage spreads, despite the company having taken lending rate hikes in the past. But more importantly, we'll be watching out for management's commentary with respect to the shift in the growth strategy given the liquidity crunch and funding situation. That's the most important thing to watch out for. Also, the move in the incremental spreads and margins and asset quality trends in the corporate and LAP segments. So lots to watch out for in terms of what the management commentary comes in.
All right, thanks so much for that, Shraddha. Sticking with earnings now, HUL kicked off the sector's earnings season on a strong note on Friday, with healthy consumer demand leading to double-digit volume growth in the second quarter. What were the key factors, and what in fact was the management's outlook? Darshan Mehta is joining us with all the details there. Darshan, what do you have for us?
Yeah, so it was in lumber, which pretty much met our estimates. If you're looking at the top line growth, slightly lower than what we were anticipating. We were anticipating close to 93-80 crores. They've come in with 90 to 34 crores. 11% top line growth, profit up 19%. EBITDA margins at 21.8% versus 21.2%. That's the trend. The volume growth also coming in at the higher end of what we were anticipating. So 8 to 10% was the band that we were anticipating, came in at 10%. Domestic consumer growth came in almost 12%. Given the fact that there was savings that was done and leverage in other expenses, that helped HUL come out with a stronger margin this time around. Individually, if you're looking at it, what happened with the home care segment, fabric wash and household care delivered double-digit growth. Market development and premiumization continued for the home care segment. On the beauty and personal care, broad-based growth was seen across personal wash and personal segment. Hair care witnessed strong double-digit growth. And as far as the food and refreshment business was concerned, that delivered broad-based double-digit growth for the quarter. Ice cream and frozen desserts and food performed well with double digits. So overall, strong numbers coming, inline set of numbers coming in, the traction coming in. But remember, this comes on a base of now that base is increasing for them. So going ahead, their analysts have pointed out concerns in terms of how they will be able to grow at a higher base and what the company is looking to do, given the fact that input costs have gone up and the rupee depreciation is certainly not benefiting the company.
All right, thanks so much for that, Darshan. Well, Shraddha Babla is back now to tell you about the stocks in news. Shraddha, clearly earnings in focus, but what are the other stocks on your list today?
Earnings again, Alex. Some companies which reported numbers over the weekend. You have AU Small Finance Bank, which reported more or less in line set of numbers, while net interest income grew by 46%. Net profit growth was restricted to 34%, mainly as OPEX grew at a much faster pace than the top line growth. Net interest margin took a slight beating on a sequential basis due to rise in cost of funds, and gross NPAs improved marginally from 2.17% to 2.03%. Disappointment coming in from Avenue Supermarts. While revenues grew by 38%, net profit growth came in only at 18%, and that's mostly to do with the operational performance, where EBITDA grew by 22% and EBITDA margins fell from 9% to 7.9%, and this is more to do with the company's conscious strategy to offer price cuts to consumers, so that has had a bearing on the margins. Negative development. Jai Bharat Maruti, again weak set of numbers, because while revenues were able to show a growth of about 25%, net profit fell by 1%. That's largely to do with higher finance costs, and EBITDA also took a EBITDA margins also took a hit, mainly on account of the higher operating costs. So margins came in at 8.8% versus 9.5%. You also have CESE, which has spoken about its demerger plans, where they will be dividing the company's non-power investments into retail and venture companies. So every existing shareholder who holds about 10 shares in the company will be getting additional 6 shares in the new retail venture and 2 shares in the venture company. The restructuring, the record date for the restructuring is set at October 31st, and these 2 companies will be listed on the exchanges at a future date. Additionally, there's a business standard report which says that Alibaba and Amazon India are eyeing stake in CESE, so in CESE Spencer Retail, so watch out for CESE. Also NALCO, where the board has approved a share buyback and they fixed a price of 75 rupees per share. This is a 12% premium to Friday's closing price, so watch out for that name. And 8K Software Miles continue to remain in focus. The management has said that there is a legal recourse that has been taken against 2 broking firms by the promoter, and the promoter has said that this is about 8.42% of his stake that was held by these brokers have been wrongfully and illegally transferred through off-market transactions. So let's see how that one reacts, but those are some of the names to watch out for.
Absolutely. Thanks so much for that, Shraddha. Moving on now, former Finance Minister P. Chidambaram has stated that he thinks the central government does not know how to manage the economy. Speaking to Sanjay Pugalia of Bloomberg Quint, Chidambaram said that the government missed the opportunity to utilize the gains when crude prices stayed below $50 a barrel. Not just that, he also painted a gloomy outlook for the government's fiscal deficit and current account deficit targets.
The macro economy is in very poor shape today. That's because the current government missed a huge opportunity when crude oil was down to $40 a barrel and didn't cross $50 for nearly 2.5, 3 years. That was a time to fix the roof. It's only when the sun shines you can fix the roof of the house. They missed that. And now they don't know how to manage. Crude oil is close to $80+. They don't know how to manage. By way of contrast, we managed it when crude oil was averaging $105 a barrel and it shot up to $147 a barrel. Net result is current account deficit is out of control. It will surely cross 2.5, maybe 2.8, maybe even touch 3%. Your fiscal deficit is under pressure. It'll be lucky if they can contain it at 3.3. They may slip. Your rupee is the worst performing currency in 2018, depreciated by 18%. Your market today is at the same level as it was on December 29, 2017. The entire gains made in 2018 has been wiped out as of yesterday. Interest rates are rising, which means EMIs will rise, cost of borrowing will rise. Banks are flush with deposits, but there are no takers for credit. Credit growth is low. Foreign portfolio investors are pulling out their money. Now, all this shows that the government seems to be overwhelmed by the events and they don't know how to manage it.
Well, that is a gloomy portrayal of the handling of the economy by the government. For the entire interview, though, so that you're not just looking at something out of context, you can log on to the website, bloombergquint.com, and search for that interview with Bloomberg Quint. Let's talk about one of the major talking points from that interview. In fact, it was the crude oil prices and the fact that they've risen so sharply. The International Energy Agency cut forecasts for oil demand this year and next because of growing threats to global economic growth. In conversation with Bloomberg's Francine Lacroix, Neil Atkinson, who is the head of the oil industry and markets division at International Energy Agency, warned that dwindling spare oil supplies will keep prices high. Take a look.
We've revised down our demand growth numbers, which helps take perhaps a little bit of heat out of the market. On the other side of the balance, what we have seen as we approach the onset of the US sanctions against Iran is that there has actually so far been a very large increase in supply from other producers, led by Saudi Arabia and Russia, Iraq, the United States. So at the moment, there's plenty of oil in the market, but you're right to point out that with the uncertainty about Iran sanctions after 4th of November, ongoing concerns about the situation in Venezuela, we are running very, very close to maximum capacity in the industry. We said in our oil market report this morning that the industry is running flat out. And because it's flat out, that is likely to mean that prices will be supported at relatively high levels.
Neil, 2019 looks like it could be very different from this year with, I guess, maybe demand dropping. Are we potentially looking at the return of an oversupply in 2019?
Well, that is possible. But again, as far as supply is concerned, we just have to wait and see what the final impact of the Iranian sanctions are, and also what happens in Venezuela, and whether other countries that still have some spare capacity, Saudi Arabia being the most prominent, whether they increase their output too. So yes, 2019 is shaping up to possibly being in a situation where supply is plentiful, but there's a lot can happen yet between now and the beginning of the year, and I think we're going to hold fire on calling an oversupply for 2019 just yet.
Neil, what's the big discrepancy between what traders say the oil price will go and the fact that OPEC is actually saying they're just not seeing enough demand? Who's right?
Well, I'm not a trader. I've never been a trader. I never will be a trader. They live in a world. They live in a world of their own. We look at the fundamentals. At the moment, there is plentiful supply, and at the moment, we have seen a modest downgrade to demand growth. And we think that the likelihood is that if we are to change our demand outlook for 2019, it's more likely to be the downside than the upside, although we can't be sure about that. So for the time being, we think that prices will remain supported where they are simply because of the lack of spare capacity, but there will still be supply available to the market. The risk we have is if there is any other kind of emergency or special event that takes place, then of course the market is exposed because there just isn't enough spare capacity available from producers to help.
Now, Saudi Arabia featured prominently in what Neil Atkinson was just talking about, but here's a completely different subject. Saudi Arabia, in fact, is running out of time to explain to the Trump administration what happened to journalist Jamal Khashoggi within its consulate in Turkey. President Donald Trump and his aides are more and more convinced that the Washington Post writer died after entering the Saudi consulate on the 2nd of October. to pick up a document for his wedding. President Donald Trump, meanwhile, has said that the US could take what he called very, very powerful, very strong measures against Saudi Arabia if its leaders are found responsible for the Saudi citizens' fate. The kingdom has denied involvement in Khashoggi's disappearance. But remember, the Saudi Crown Prince Mohammed bin Salman is being hailed by some as a reformer, but his crackdown on dissent is raising eyebrows internationally. Here's an in-depth report.
The prince surprises us every couple of weeks or couple of months with a huge multi-billion dollars project that wasn't discussed in a parliament, wasn't discussed in newspapers, and the people will just clap and say, hey, great, let's have more of those. And things don't work that way.
Well, that's all we have for you in this edition of Daybreak. But up next, after just a very short break, is all you need to know. So do stay tuned. This is Bloomberg Quint.